Among the people who give you advice on economics and investing, there are a few you probably want to take them seriously.
What we saw in the 60s and the 70s.
Well, I think it's worth looking at the 1960s because I suspect younger people have a pretty hazy idea of what happened.
To me, that potentially we're doing the 1960s on steroids, and we're doing it for the same basic reason we did it in the 1960s.
And of course, Michael Burry, the famous Big Short investor who successfully bet against the big banks during the financial crisis. These think tanks usually view the problems in the economy from different angles, but this time, they all warn about one commonality out of the pandemic. In this video, I want to do a step-by-step analysis about their warnings against inflation. We're going to look at the origins of the Great Inflation in the 60s and 70s, and why Niall Ferguson and Larry Summers were both warning that the current circumstances share the same characteristics as a prologue to the Great Inflation. In February, Michael Burry tweeted, "People say I didn't warn last time. I did, but no one listened. So I warned this time, and still no one listens. But I will have proof that I warned." What's Michael Burry talking about? He's talking about inflation. Then he went on to warn about the stock market bubble. He warns that the margin debt popularity accelerates at peak. He's saying at this point, market is dancing on the knife's edge. This blue line shows the value of the S&P 500. The red line is inverted, meaning that the higher the value, the lower the line goes. Prior to the previous two recessions in 2001 and 2008, margin debt both reached its highest level. Now we're having the same circumstance that more people are borrowing money from their margin account to bid up the stock price. Burry then tweeted why government is inviting inflation. On February 20th, he tweeted that the US government is inviting inflation with its modern monetary theory tinged policies, brisk debt to GDP ratio, M2 increases while retail sales PMI stage V recovery, trillions of more stimulus and reopening to boost demand as employee and supply chain costs skyrocketed. Basically, Burry is saying that there are three forces that can potentially drive up inflation. A lot of money in the form of cash, money market securities, or mutual funds that are flowing around waiting to be spent. Economic recovery and government spending boost demand, and the cost of worker and rising commodity prices might eventually push up the consumer price. Last but not least, people don't seem to care about inflation because it hasn't happened for 40 years. Most of us aren't old enough to get a feel of the double-digit inflation in the 70s, but in order to understand whether inflation is ahead, we need to roll our time back to the 60s when inflation was brewing its seeds.
The large military and social spending practices of the 1960s and 70s were two key factors that led to a major economic downturn by the end of the 1970s.
In the first half of the 1960s, US was able to enjoy strong productivity growth. Inflation was well under 2%. Then comes 1965. It was the last year of strong productivity growth and the first year of rising inflation. Democratic president at the time Lyndon Johnson was borrowing money to push for guns and butter. President Johnson was a populist. In 1965, he urged further government spending and proposed a reduction in excess tax. This was part of an ambitious program to achieve the Great Society, known as the Butter, by increasing funds for poverty programs, welfare, and training. But the fiscal stimulus doesn't just stop there. Military spending to support the Vietnam War, known as the Guns, reached $58 billion and $71 billion in 1966 and 1967. But the problem was, US government was not able to collect enough taxes to finance the spending on guns and butter. When government expense exceeds its income, we call it the budget deficit. In 1968, budget deficit reached 2.6% of the total income of America, which was the highest since the end of World War II. One of the primary dangers of a budget deficit is inflation. Because Federal Reserve buys government bond to finance the spending, at the same time release more money into the economy, which drive up prices. To study what caused the Great Inflation, monetarists like to use these two charts to describe the relationship between money, economy, and inflation. The one on the left shows the excess of money supply relative to real economic output. The one on the right is inflation. If you lay these two charts on top of each other, they match pretty well. It means when money supply grows faster than the actual economy, it creates inflation. In comparison, this is where the line's at now. So are we doomed to have inflation? Not yet. In a country, there is someone who controls inflation. Two primary responsibilities of a central bank is to 1. Strive for full employment, make everybody have a job in the country, and 2. Maintain price stability. In other words, control inflation. But the central bank prior to or during the Great Inflation didn't do a great job. When inflation goes up, market naturally demands higher interest rate to compensate for inflation. But in the 60s, under the pressure of the government, increasing interest rate will hinder the government's ambitions for a greater society and international influence. Central bank, though an independent entity, was compromised not let interest rate rise fast enough to combat inflation. During the 60s and 70s, checking inflation was a second priority. It was all about jobs. People had strong faith in the Phillips curve. They think increase in inflation is the price paid for lower unemployment. They were willing to pay the price without tightening the policy. Central bank was no exception that got caught in the philosophical and political currents that were transforming American life and culture. It puts a lot more weight on employment than inflation. Even though the Fed were well aware of the risk of inflation, it was not able to hold its footing under the pressure of the government. Even more, Fed chairman at the time, William Martin, was under the pressure of his own belief that the Federal Reserve is only independent within the government. During this time, inflation expectation was not well anchored, meaning that the public didn't believe maintaining price stability was central bank's priority. That was indeed the case. Between 1964 and 1979, the Fed could have restricted money supply to terminate inflation with little delay, but it failed. On the contrary, if people expect the Fed to have the will and the tools to bring inflation down, we're probably not going to see that much volatility in prices.
Petrol stations can no longer afford to fill up cars whose tanks take 20 gallons.
Most people think the oil shock was the cause of the Great Inflation, but the real cause was inflation expectation. When you don't trust the central bank could bring inflation down, at the same time you know tomorrow's price is going to increase, you may want to buy 2 cans of beer instead of 1. People will demand much higher wages, and businesses will be forced to increase prices as well.
Well, I think it's worth looking at the 1960s because I suspect younger people have a pretty hazy idea of what happened with inflation before they were born. And the typical view, in my experience, is, well, that was something that happened in the 1970s because of the oil shock. That's not quite right, actually, because what happened in the 60s was that in the first half of the decade, inflation was low, it stayed well below 2%. And then in the mid-60s, it took 2 big jumps, first up to 3%, then up to 6%. And that was the moment that inflation expectations became unanchored, as we would now say.
Let's do a quick summary of what caused inflation in the 60s and 70s. First, fiscal deficit, meaning government is spending more than it brings in, which needs central banks' help to buy government bond, thus release more money into the economy to drive up prices. Second, money. This includes interest rate, money supply, and probably the most important but often overlooked, the central bank's rhetoric that affects inflation expectation. Now central bank's rhetoric may repeat the same mistake as the 1960s.
But the key is expectations. The Fed today seems to have a theory that inflation expectations will not be affected if there is a temporary bump in inflation in the second half of this year or the beginning of next year. I don't think that's historically very well founded. The lesson of the 60s is that if you do the Great Society, if you do butter and then you do guns as well, which was Vietnam, then you can get inflation expectations unanchored.
The Fed traditionally makes clear that it's going to be preemptive with respect to assuring price stability, limited inflation. Now the Fed is mostly concerned with preempting the possibility that it would have to raise rates by explaining how if there is inflation, it will just be transient and so forth, by directing attention not just to employment goals, but to employment goals for specific demographic groups.
What Larry Summers is saying is that central bank today may have been repeating the same mistake as in 1960s, where they, directing more attention on employment, place a high importance on interest rate normalization, and as in the 60s, put inflation as a second priority. There are two potential scenarios at play here. One is central bank let inflation run wild, which is probably what they're going to do if inflation ever came. Second is they're going to raise rates and put constraints on credit, which might bring the financial market down as well as the economy, at a time when interest rate is already above zero and with a lot of QE. If they chose this path, they're going to have to print even more money, which eventually threatens the dollar as the world's reserve currency and cause all kinds of social economic problems. So most likely they're going to choose the first path, which is to let inflation run its course. This is also why they have said they will be willing to accept 3% inflation for the time. And of course, there's the third scenario in which economic rebounds without much inflation and everybody's happy. Now let's look at how Larry Summers compares the characteristics between the 1960s and 2021 and get to know why they're not only similar, but the stake is much higher.
What I do know is that LBJ's guns and butter was about 2% extra on the federal deficit, and that interest rates were a few percent, and nothing like quantitative easing was imagined in the 1960s. That today we've got extra stimulus closer to 10% of GDP. We've got interest rates not just at zero, but the central bank vowing to keep them at zero, and we've got QE. And so that tells me that potentially we're doing the 1960s on steroids, and we're doing it for the same basic reason we did it in the 1960s. We'd lived through a substantial period of anchored inflation, so we were complacent about the inflation threat, and we had needs that political leaders felt were pressing and wanted to push on with. So I think the dangers of repeating in some way the 1960s experience are very great.
Having said all these, we have another problem. We only gathered the evidence for potential inflation, which might make you wonder, is there the other side of the coin that says we're not going to have inflation? Now we know that fiscal and monetary policy are the two main characteristics that drive up inflation. Let's look at what happened in 2008 and do a comparison. In 2008, we actually printed more money relative to GDP growth, which didn't cause inflation. Even though higher today, in 2008, we were also running close to 10% fiscal deficit, which also didn't cause inflation. If you'd like to know why the 2008 financial crisis didn't cause inflation and why we had consistent low inflation for the past 4 decades, you can check out this video where I talk about the reasons in detail and how they're different today. Whether we're going to have inflation is yet to be known, but judging by the amount of deficit spending by the government and central bank's stand on monetary policies, I will keep a close look at whether expected inflation derails from its target. For now, the risk of inflation is pretty substantial.